Net income. Net income is the last line item on a company's income statement, which is why it's sometimes called the bottom line. To calculate net income, you take the total sales of a company minus expenses like cost of goods sold, selling, general, administrative, operating expenses, depreciation, interest, and taxes, add back in other forms of income, and then you get the bottom line. It's a really simple concept, but understanding how to evaluate it is important for an investor. So let's talk about that. When you look at a company's net earnings for a single year, you're not really getting much information other than whether or not the company is actually producing a profit. To get any real value, you need to look at historical net earnings and whether or not it is consistently growing. It's okay if the earnings picture is a little bit rocky, but as long as long-term the trend is upward, the company is in a good spot. Consistency in earnings and long trends upward are the two components that make up durability. You've heard me mention durable competitive advantages multiple times, and I've shamelessly stolen the term from famous investors such as Warren Buffett. Okay, I told a little bit of a lie earlier. The last thing you'll see when you look at a company's income statement is actually not net income. It's earnings per share. However, as the name implies, earnings per share is a ratio and not an original value. To calculate earnings per share, you take net income and divide it by the number of shares outstanding. Many retail investors focus on earnings per share, and it's one of the few metrics that most brokerages will actually share with you. At first glance, you would probably assume that net earnings and earnings per share would grow at the exact same rate, but this actually isn't always the case. Why do you think that is? A very common tactic of financial engineering that companies employ is a share buyback program. Essentially, a company can take their retained earnings, which we'll get to later, and use that to buy shares off of the open market. Once the company has control over the shares, once again, there's a couple different things they can do with it, such as retire the shares or issue them to employees or keep them as treasury stock. That's a little advanced for right now, but the point is, if earnings remains constant, but your share count goes down, then earnings per share goes up. And so if a company has a large share buyback program, it could be possible to see earnings per share trending upwards while net income remains constant or goes down. This is why it's important to have a holistic understanding of a company and not just relying on a few metrics before making an investment decision. Okay, I talked earlier about durability and how it relates to a durable competitive advantage. Let's talk about the second half of that since this is going to be a short video. A competitive advantage just means that in relationship to their peers, the entity has an advantage. This term is obvious, but how do you actually identify a company with a competitive advantage? You could probably guess, since this is a video on net income, that it has something to do with that. And you're right. If you take net income and divide it by your total revenues, you get net profit margin. You can take that percentage and relate it to companies across the industry, or even across industries, just to see how competitive an industry is, or the overall economics of a business type. And that's it for now. If you like this video, please like and subscribe. And our next series, we'll start getting into the balance sheet. So make sure to stay tuned for that. We'll see you next time. 6.